All right. Well, look, I think I might get started. So welcome, everyone. Thanks for joining us and taking some time out of your busy schedule. My name is Peter Burns. I'm a Senior Sales Executive for Morningstar Investment Management, and it's my pleasure today to act as your host for today's webinar. Joining me today is Daniel Needham. Many of you will be familiar with Daniel. He's a Sydney boy who's risen through the ranks to now hold the illustrious position of our Global Chief Investment Officer and President of the Morningstar business. Daniel is joining us from Chicago. Welcome, Daniel. This is the fourth in our 2021 webinar series. These webinars are designed to keep you abreast of our current thinking. And somebody's just commented, Peter, you're looking old. Thanks, Steve, for that. Yeah, these webinars are designed to keep you looking abreast of our current thinking, particularly from our investment management and our behavioural finance teams. Today, the focus shifts back to investment markets and the questions around the re-emergence of inflation. The backdrop to today's presentation really goes back to the GFC, when we started to see the emergence of central bank support for financial institutions and economies. This was ramped up substantially over a year ago as we saw the COVID correction occur, with governments entering the fray with their own stimulus programs. Since then, we've seen very strong markets as investor confidence returned. But with an improving outlook for global growth, there is some commentary emerging around the risk of the re-emergence of inflation. So I guess today, Daniel will address these questions. Questions such as, is this a risk? How large is it? What's being priced into markets? And how are we positioning our portfolios? Before we get started, we have our disclaimer slide. Daniel, if you can just flick to the disclaimer slide. As is the norm, the information that you'll receive today does not take into account anybody's personal circumstances. It is general in nature. Next slide, please, Daniel. A little bit of housekeeping. You will be getting CPD points accredited from the FPA as normal. We will get these sent out to you, and there will be a recording of the session, and that'll be made available also to you within the next week or so. Next slide, please, Daniel. Lastly, Q&A. Please use the Q&A box at the bottom. You can see where that arrow is leading you there. There is also a chat box. We'd prefer if you use the Q&A if that's possible. So with that little introduction, I'll hand over to Daniel, who'll take us through the next sort of 45 minutes or so.
Great, thanks, Peter, and good morning, or I guess it's lunchtime there, so maybe good afternoon, everybody. It's getting into the late evening in Chicago, and it's great to be able to join all of you to talk about markets. So, as Peter introduced, the topic really of discussion is inflation. It's starting to come up again, and so we're going to tackle it from three perspectives. So, firstly, understanding the fiscal and monetary policy implications from COVID-19. And then, we're going to look back at history a bit to look at inflation and some of the more extreme forms of inflation and their drivers, and then a quick look at the outlook and positioning. But want a lot of questions, so fire the questions in as we go, and we'll be sure to make sure that there's a lot of time to answer them. But I would say one of the most common questions we're hearing now, and what we're seeing in the media is, with all the fiscal policy around the world and the monetary policy, what does that mean for inflation? And I'd say if you think back the last 30 years, it's been more of a deflationary system around the world, and there's lots of different explanations for that. But obviously, there's the role of China, the increasing globalization of labor markets, technology. These are kind of disinflationary forces, and governments around the world, frankly, have been trying to generate inflation without a lot of luck. And so we've kind of found ourselves in a pretty unique situation. So there was an extreme economic event with the pandemic, and it surprised pretty much everybody from a sort of a markets and a policy perspective. And so governments responded, but really the US is the main policy driver around the world because it's the largest economy, and even more importantly, it's the reserve currency. And so everybody's aware of what the Federal Reserve did, expanding its balance sheet. So there was really a response that started in 2008 with the global financial crisis, but it's continued as the central bankers continue to try to stimulate the economy as the global economy had sort of emerged from the global financial crisis. But you can see here, there's a really extreme increase in the Federal Reserve balance sheet around March of 2020, last year. At the same time, we've seen interest rates get lower and lower as the Federal Reserve has effectively pinned them close to zero now for over a decade. And so this is a really extreme monetary policy setting, combined with fiscal packages around the world. So this looks at how much governments have spent relative to their 2020 GDP. So since the beginning of 2020. So Japan, over this period, has spent nearly half its economy size in fiscal and government packages. And you can see countries like Italy have spent a fortune. The United States is up here, but it isn't near the top. But they've spent nearly 30% of GDP. When you consider that they're the largest economy, that's a huge amount of spending. And so one of the natural questions that comes from this is, what does that mean for inflation? And I think generally this level of fiscal policy or expansion is reserved for wartime. So the last time that we've really seen these kind of fiscal deficits and fiscal stimulus is really related to war spending. Now, this has caused a substantial recovery in the global economy. And so what we can see here is effectively the IMF's, the OECD's economic growth projection. So this was their projection. The blue line was their projection from November 2019, pre-pandemic. And then we saw the December 2020 projections, which is the orange one. But you can see the economy cratered. I mean, this is really an extreme fall in economic output. We haven't seen many periods like this outside of war times or depressions. And so we saw this coordinated global collapse. Governments responded, and then we've seen this really, really quick recovery. And so we're at a point now where things are leveling off a bit. And a lot of that's got to do with the uncertainty of the pandemic. So there's a bit of a stop-start impact around the world as governments will kind of come out of lockdown and then re-enter lockdown. And so that is really causing a lot of uncertainty. Now, the vaccine rollout is creating a lot more optimism in markets. And as you can see, the OECD is projecting that growth is actually going to be exceeding the pre-pandemic level somewhere towards the end of this year. And what is likely to happen is, as we're starting to see how well the US is doing, places like China are doing, is that actually we could see this green line actually accelerate even more. And so there's some economists out there who actually think the economy will catch up with the pre-2019 projection, but Europe is still a big uncertainty. India is still a big uncertainty. Latin America is still a big uncertainty, and they will weigh down. But assuming that those countries can navigate the pandemic, and so really it's about vaccines, and it's about being able to stimulate income. So we've got that backdrop. So the question is, what does that mean for inflation? A lot of people now are starting to talk about the risk of hyperinflation. That there's, for those Austrian economists out there, sort of making reference to the Weimar Republic. And so I think it's important to look back at the different types of inflation that exist, and then look at some of those drivers, and then ask, does this apply here? What has changed? What is different? So just a quick sort of run through of inflation. So this is a very simplified sort of version, but let's start with deflation. Deflation is when there's a decrease in the price level as measured by the consumer price index. Disinflation is when the level of inflation, so prices are increasing, starts to slow down. It's not outright deflation. I would say that the developed world has been in a period of disinflation for the last 25 years, 30 years. Then inflation is when you've got increasing in prices, but it's a pretty controlled, steady level. And then hyperinflation is when you've got really high inflation that is increasing. So effectively, it's high inflation where prices are increasing at an increasing rate. And so effectively, deflation now is pretty rare because the majority of the world operates in a fiat currency system. But what is even rarer is hyperinflation. And so we'll talk a bit about that now. So hyperinflation gets thrown around a bit. And the first time we really started to hear about it was in 2009 when there was a lot of money printing, and everyone was talking about, or not everybody, it was very common to be concerned about hyperinflation. So hyperinflation is actually a relatively rare bird. And so it's happened a few times in history. So there was a lot of hyperinflation around World War I. So you had Austria, Hungary, the Weimar Republic, Poland, Russia. And then post-World War II, we've had a few periods. So we've had it in China, Greece. These were around World War II, so related to the end of World War II. And then we've also had Argentina in 75. We had Bolivia in the early 80s. We also had Brazil in the late 80s, early 90s. And then Zimbabwe was the most recent one, which I'm sure many people can remember. Now, hyperinflation, contrary to what the monetarist view is, which is that I think Milton Friedman's view was inflation is always a monetary policy phenomenon. And so actually history doesn't support that thesis. History suggests that hyperinflation requires a number of conditions to hold. And so if we look back through history, there's really three main drivers of hyperinflation. Firstly, there's a large contraction in supply. Often that's caused by a war, a regime change, or sometimes there can be some shock or unexpected event like a natural disaster. But generally what's required is a contraction in supply. The economy can't produce the amount of output that people are demanding. Secondly, there's normally the requirement for there to be hard currency debt. So the country that's having the supply shock has got debts in foreign currencies that they need to meet. Often they can also be dollarized, where they move from their own domestic currency, and then people lose confidence and so move to a foreign currency like the US dollar or the Deutschmark before the Eurozone in other parts of Europe. And then another important point is what we call the transmission mechanism. So often that is a wage price spiral. So you have the contraction in supply, demand stays constant, which creates a gap. At the same time, the fall in demand effectively leads foreign creditors to assume that the country can't meet the debt. So foreign creditors start to take money out of the currency. The currency falls relative to the foreign currency, which effectively drives up import prices, which creates inflation in the economy. At the same time, those that are effectively earning money to live off, wages, have to meet the rising prices in the economy. So therefore, labor demands more wages. And often there can be a bit of a distributional struggle. So the stronger that labor is in that country, the more likely that you'll see wages increase a lot. You also see indexation. So for example, government employees may have their wages indexed to CPI, or pensions may be indexed to CPI. Sometimes taxes are indexed to CPI. So when you have these three elements, that creates the conditions for hyperinflation. Then what happens is that often there's money printing, or people are trying to stimulate or print their way out of it. And so when you have that, that's when you get the conditions for hyperinflation. They're very rare. And what is a requirement, which is the money printing, is not a necessary condition. You need to have these other elements. And so firstly, I guess the takeaway here is people that are talking about hyperinflation with the money printing or the central bank expansion are not appreciating how rare it is. And the real question is, do you have a big contraction in supply? Is there a dollarization or hard currency debt? And do you have a wage price spiral? I'll talk a little bit later about why these are very unlikely. But the global financial crisis didn't meet these conditions. Actually, COVID-19 got close on the first item because there was a significant contraction in supply because factories shut down. And so that big pulse through the economy, what happened was that effectively things stopped getting produced. But at the same time, demand dropped as well as people were unemployed, they couldn't consume. So demand and supply fell at the same time, which actually reduced the pressure. But outside of that, we haven't really seen the conditions outside of these countries that I've referred to. Now, the most common drivers of inflation in our world are a combination of positive demand shocks or negative supply shocks. So firstly, let's look at demand. So a positive demand shock is when you have an increase in global demand that pushes up against a fixed supply, which effectively drives up inflation. And historically, it's also driven up the oil price. A negative demand shock is when you see demand fall relative to supply and it creates excess supply. You see lower inflation and generally falling oil prices. Now, that's obviously what happened in the global financial crisis. That's generally what happens in a recession. Then you can have supply shocks. So a positive supply shock is when there's an increased amount of global supply, which actually lowers inflation and decreases oil prices. I would say the productivity growth we've seen, technology over the last 2 decades, arguably has created positive supply dynamics. So therefore, you've had less inflation pressure. Negative supply shocks, everybody's going to know this one. This is what happened to oil in the 70s. Effectively, there's a reduction in supply, which effectively drives up inflation. So you reduce supply, which means demand exceeds supply and prices go up. Oil is really the only big negative supply shock we've seen, but that's actually the one that I think is burnt in people's memory, and so we'll spend a little bit of time on that. So this is global inflation back to 1960, and as you can see, so this is annual inflation, and this period from around 1971 really through until the early 90s was really a period of what I would call high inflation. It wasn't a period of hyperinflation, but it was a period of sustained high inflation. And really what we saw there was a unique set of events that we think are unlikely to reoccur now. And it really had a lot to do with oil. So there was effectively a negative supply shock. So that was a 1973 oil embargo, where effectively the OPEC countries decided to embargo the United States because of their stance, effectively supplying oil and resources to Israel. And effectively they put an embargo on, and then they increased the price of oil to countries that were supporting the US. That drove the oil price up. It doubled and then it quadrupled. And effectively that led to a supply shock. There actually wasn't a material reduction in the supply of oil, but it was effectively constrained. And at that stage, the economy was very dependent on oil, and it caused a ripple through the system. It also happened at the same time in 1971 when Richard Nixon took the United States off the Bretton Woods, off the gold standard. Between 1971 and 1973, effectively, the world moved from a fixed exchange rate regime to a fiat currency regime or a floating exchange rate regime, which created uncertainty around inflation. You also had the wars, the Vietnam War being fought in the United States, and so there was a huge amount of fiscal stimulus related to that. There were wage and price controls that were put in place. And so it was a period of a rare combination of events that drove a lot of inflation. And so we saw this big increase in inflation. There was another oil crisis related to the Iranian Revolution in 1979. And then also we had the Gulf War. Now, oil was a very important mechanism into the system, but what we didn't see was hyperinflation. This didn't turn into hyperinflation because you didn't have a supply contraction. You didn't have a hard currency dependency on the US. The US didn't have a foreign currency debt, and they also didn't have a wage price spiral, but they did have very powerful unions. And so the distributional struggle between employers, between companies and employees also stimulated the inflation, but effectively it got to this point. And so the question that I can ask for Australia is this a likely outcome in Australia? Firstly, this shows the trade union membership through time in Australia. So is the wage price spiral a risk in Australia now? We would say no, it's not. Effectively, union membership has declined. And if you think about capital versus labor and the distributional struggle, around the world, capital is in charge relative to labor. Unions are weaker. Their ability to drive wages up is much lower than what it has been historically. And there's a wider supply of labor around the world. So we think the conditions for the level of inflation that occurred in the 70s is actually quite low because of this effectively weaker bargaining power of labor around the world. At the same time, the world is a lot less dependent on oil. So this looks at Australia's oil intensity. So it's oil consumption divided by GDP. And what you can see that when the oil crisis hit, it was at a time when this is representative of the US economy and the world economy, frankly, at a time when economies were very dependent on oil. Oil represented a much larger input into production in the economy. Well, that's declined a lot. It's actually declined significantly. And so the risk that an oil shock or a negative oil supply shock would drop like it did in the 70s is very low, very, very low. It's possible, obviously, the future's uncertain, but we think very unlikely. And so from our perspective, when we look at the current conditions, we think that with the fiscal stimulus and the monetary stimulus, there is the risk that we see higher inflation. So we see inflation move from this disinflationary environment to more stable and maybe even rising inflation. But we don't see the level of inflation in the 70s as likely. It's always possible. Obviously, the future's unknowable, but we just don't think that's likely. We think the conditions are not there for the type of transmission mechanisms that are required to drive that inflation up. Now, some people will say, but look at the level of government debt around the world. Look at the level of fiscal policy, right? Like, surely we haven't seen anything like this for years. How can you be so sure that that level isn't going to drive some type of monetary inflation or some level of hyperinflation? And the good news is that we've actually had a case study underway globally around the world really for 3 decades, and that's Japan. So this shows Japan's general government debt to GDP in 2015. So it's up near 250%. To give you an idea, Australia was down here, and the US was around 130%. So this is gross general government debt, not net general government debt. But so effectively, what you can see is that Japan had very high government debt, which was driven by really high fiscal policy, fiscal stimulus. And the Japanese central bank was building more and more banking reserves. So effectively, the Japanese government was buying Japanese government bonds and other instruments in exchange for banking reserves. So effectively, to use a common term, the money supply was expanding significantly and their balance sheet was expanding. So this is a measure of extreme monetary easing. So the question is, what happened to inflation in Japan? So what we can see here is, so the blue line, the light blue line is Australian inflation. So it's rolling annual inflation. The purple line is US inflation. And the green line is actually Japanese inflation. So what we can see is that Japanese inflation actually has been skirting with deflation. So it went slightly negative in 2016. So rather than the money printing, for want of a better expression, and the fiscal spending driving inflation, it actually didn't have an effect on inflation. And we saw the Japanese economy actually experience deflation over this period. And so the model that is most common, I guess, that's used when people talk about inflation is what's called the quantity theory of money. So effectively, it says that the amount of money multiplied by how much that money circulates in the economy equals prices in the economy multiplied by output. So money and how much it moves around equals nominal output. Now that's an accounting identity. It has to equal. And so the quantity theory of money would say that actually velocity, or how much it moves around, is constant, and output, real output, can't be affected by money. And so the only thing that central banks can do when they move money up and down is drive prices up and down. Now, that's a defunct model because the velocity of money actually isn't constant. And so what you actually find is that money is an endogenous variable. So it's not something that central banks can control. The central banks can control the price of money, but they can't control the volume of money, which means that a lot of the monetarist frameworks, so when people say money supply is increasing, worry about inflation, they're basing it on a flawed model. So we think what's more important to focus on is how much is demand exceeding supply. And so we're in an environment where effectively the economy had a lot of excess supply built up as people were unemployed and weren't spending. The government's filled it. And now we're seeing demand increase and the governments will start to step away. And so we don't think we're in an environment where the level of central bank expansion and fiscal policy is going to cause the kind of inflation that people are worried about. So what does that mean for portfolios, or how do we view things now? Given we're not worried about really high inflation or hyperinflation, it means that we're not as concerned about investing in financial assets as other people would be who are concerned about hyperinflation. Markets are also reflecting higher inflation. So markets are pricing in higher inflation. So this shows break-even inflation, which is the nominal government bond yield less the inflation-linked bond. So for example, it would be in the US, it's the 10-year government bond less the TIPS yield. And that gives you what the market's implying for inflation. And so what we can see here, firstly, is this is Australian break-even inflation on the left. So you can see there's a drop here around the pandemic in March 2020. And then since then, we've seen a steady increase in the market's expectation of inflation. And we're seeing the same thing in the US. So we're kind of back to the market's expecting inflation somewhat similar to what we've seen in the last cycle. Now in the US, we've actually seen inflation increase even more. And so markets are starting to price in higher inflation, which we think makes sense because if we're in an economic expansion where we believe we are, it's likely that we'll start to see wages increase. We'll start to see prices in the economy increase, which we're already seeing. That's actually normal in an economic expansion. And so we're not concerned about it. So what we're going to be doing is looking for value across the markets. And so looking at a portfolio or an opportunity set for Australian investors, parts of the market that stand out to us right now are European energy, UK equities, European telcos, European financials, global energy, emerging market local currency debt, and Japanese equities, EM equities. On the less attractive side, this is what we're expecting over the next 10 years. Cash rates are going to be lower. Australian government bond yields are going to be lower. And we also think US equities are expensive. But in an environment where we're in an economic expansion and inflation is going to be tilting higher, we think it makes sense to be owning equities. So having more of an equity heavy portfolio adjusted for the reward for risk. And so right now we're tilting towards the cheaper parts of the market, but we're also recognizing that valuations are actually on the higher side. And so therefore we are holding slightly defensive portfolios. This gives you an idea of how our portfolio has changed since January 2020. So we've increased our exposure significantly to global energy. Now that makes sense if you think about how cheap energy stocks got in March 2020. Effectively, the short end of the futures curve for the West Texas intermediate crude futures contract actually got negative. And so in mid-March, around the 18th of March 2020, it was a really great time to start buying lots of energy stocks, and we were buying. Also, UK equities is a pretty energy-heavy country, and it's also, we think, attractively priced. But you can see these are the sectors that we've been increasing exposure, and we've been reducing our exposure in inflation-linked bonds and alts and the cash as well, so the more defensive parts of the market. And so generally, we've been tilting towards more cyclical parts of the market and reducing our exposure. And now, even though we think inflation is likely to be, say, surprising to the upside, we've been reducing our exposure to global linkers. And that's been deliberate because as people have become concerned about inflation, they've been paying a lot to hedge their portfolios. And we don't think it's worth paying for the insurance within the global inflation-linked bond market. So on balance, we think energy companies are pretty well set to benefit from the economic expansion. We think oil supply is looking pretty constrained, and we think demand is going to increase quite a lot. And so we think it's going to be likely an attractive time to own global energy stocks. That's why we've been increasing the portfolio so much. And so that was that's really what I wanted to cover off. I had a lot of content that I moved pretty quickly through, but I wanted to leave some time for questions. So I'll hand back over to you, Peter.
Thanks, Daniel. So we do have a couple of questions. One of them is developed countries like the US have borrowed so much that they cannot afford for rates to go up. or they'll be paying 100% of their budget on interest payments. Thoughts, Daniel?
That's a good question. So that is, I think that's correct. I think that countries like the United Kingdom, the United States, Japan, and even even some European countries, their ability to tolerate rising interest rates is a challenge for them based off the current paradigm or thinking. And so if you look at the incentives right now in the economy, it's for countries like the United States, Australia, the United States, and United Kingdom, Japan, to keep interest rates low. So from that perspective, we think we're likely to see interest rates stay low because there's an incentive to. At the same time, markets might not let them do that. So we could see inflation pick up, and we could see governments increase rates. But it's going to create a bit of a speed limit for governments, like how high they can increase interest rates, because of the perception that their ability to fund the interest payments is limited by their economic potential. Now, I'm going to present now a bit of a contrarian view, because I'm a contrarian, and that is that that actually the US government can buy all of the Federal Reserve can buy all the debt of the Treasury and then cancel that debt, and then they won't have to pay the interest rate anymore. And that actually wouldn't have that would not have a perceivable impact on on anything in the US government. Effectively, the left pocket and the right pocket would be coordinated, and they just cancel it. And so the US government spends out of reserves. They effectively spend money into creation. They don't need to borrow money to spend. And so it's an interesting dilemma. And I think we're in an environment where we could actually start to see some even more unconventional changes, where potentially the Federal Reserve could just, the Federal Reserve could forgive the debt of the Treasury. And so, but at least in the current paradigm, I think there's the expectation that governments are limited, and so therefore they'll have to keep interest rates low because debt levels are so high.
Okay, thanks, Daniel. One from Douglas. In Australia, many years ago, you were bullish on REITs, and you were right. What is your view on them now, post-COVID? Returning to bond substitute or scarred?
It's a good question. I don't at present. I don't have a strong view on REITs right now. I think on balance, we think if you look at global REITs, for example, they're more attractive because people are really concerned about office space and whether people are ever going to go to shopping centers again. So there's definitely a bit of a contrarian element to them, which we like. There's been a bit of a rally in say Simon Property Group in the US recently as well. So it's not a table thumping opportunity, I don't think. But I think there's definitely some opportunity because people are pretty negative, and so on a relative basis, I think they're still relatively attractive, but not like 2010. I mean, that was table thumping. People had given up on the asset class. I don't think we're at that level of revulsion this time around.
Okay, we've got one from Grant. Hi, Daniel. What about the focus on ESG and environmentally friendly assets and infrastructure? Will this have a negative drag on energy and oil-related stocks? If so, how much?
Yeah, it's a tough question. I think so. There's definitely the structure of the global economy is changing, and technology is moving at a pretty rapid pace, and so there's always an incentive to get away from fossil fuels because they were expensive to mine, and certainly for oil, it was getting harder and harder to find oil before fracking. So generally, there's always been a kind of a substitute in the economy. How do we reduce energy intensity? And I'd say it's just increasing now. And so oil as a sector fossil fuels as a sector is just going to become less popular. At the same time, the world runs on oil and the world runs on fossil fuels still. And once you get outside of personal vehicles, everything runs on oil. Trucks run on oil. Effectively, locomotives run on fossil fuel. Shipping runs on diesel. So all the stuff that really matters, like actually getting people around, is relatively minor from a sort of an economic output. So actually, there's a long way to go until we even come close to moving away from fossil fuel as a main thing that powers the economy. And so it's great to see electricity being substituted for wind and solar and geothermal, but China still it's still largely driven by coal. So there's still going to be a lot of demand for fossil fuels, and there's still going to be a lot of demand for oil. And so we think that on balance, even accounting for a very, very bearish path for oil because of the environmental concerns, it still looks really attractive to own the stocks. But look, there's a lot of uncertainty around it. So, I mean, coal would be the thing I'd be more worried about than oil. I don't know if I answered the question, but they're my thoughts.
Okay, just going back to your previous answer, is that last comment suggesting modern monetary policy is a realistic approach and there's no limit to government spending?
So I think that the MMT school, they really pointed out the structure of the financial system and the difference between real assets and financial assets, so the way that monetary policy and fiscal policy works. I don't think they've pointed it out, but it's actually been known for a long time. Milton, so Paul Samuelson knew about this when the fiat currency system rolled out. So people have known that the government doesn't have to borrow to spend. I mean, there's a really fascinating quote by Paul Samuelson, the father of neoclassical economics, saying that actually we don't want governments to know that they don't need to borrow because they'll spend too much money. And so it's kind of like it's been known for a long time. So the MMT school has really pointed out what has been known for some time. The difference is that, so MMT is a combination of a lens of how the system works and what you should do about it. And I think they've become very unpopular because what you should do about it is actually influenced by their more progressive politics, right? And so, but if you look at their first step, which is how the system works, actually, I think that's quite apolitical. And but I think the question actually highlights a fundamental misunderstanding with what MMT says. It doesn't say. Do you want to read the question again, Peter? It said it
says, is MMT a realistic approach? Is there no limit to government spending?
So no limit to government spending is where there's a misunderstanding. So what MMT says is that government spending is constrained by the availability of real resources in the economy. So effectively what they're saying is that if there's a shortage of real resources, government spending will drive up inflation because it's going to compete with the private sector. Now in Australian dollars, for example, no one can compete with the Australian government in buying stuff. They've got an unlimited amount of Australian dollars that they can use to buy anything. So they are constrained. Governments are constrained. They're constrained by the availability of real resources. And if there's tight supply, then excessive government spending will create really high inflation, and it could potentially cause destabilization of the currency, could cause, a deep economic recession. So they are constrained, and I don't think the MMT would ever say that statement. Now, what they're not constrained by is their ability to borrow money to spend. So the banks aren't reserve constrained, and governments aren't constrained in borrowing money to spend. And so that's really, I think, an accurate assessment. Governments have always spent money and then taxed. Since 1971, when the world moved from the gold standard to a fiat system, at least a lot of the world, governments would spend money, and they didn't have to worry about raising money like they did under the gold standard. They would spend money and then they would tax or they would borrow money. But actually issuing government bonds or buying government bonds is actually more of a monetary policy tool now for the Australian government than anything used to fund their spending. So I think there's elements of MMT which is actually quite right, but I think there are elements of it where it's mainly, if you're a progressive, you might agree with them. If you're not, you might disagree. and that's politics, and that's where I stop engaging.
Okay, a couple of questions on, and I got to take into account you are living in Chicago these days, but around residential property in Australia and this impact of people borrowing with these extreme low interest rates. Are people getting over their head? What's the outlook for Australian property? Your thoughts?
So, given my track record, both personally and professionally, with Australian property, I'm not sure that my opinion's worth a pinch of But so I mean, I think that one of the biggest concerns with the deflation machine that the central banks have been running around the world, governments have been running, which is fiscal austerity and very easy monetary policy, and continually easing, that's created actually more deflation in the system than what we faced. And so the risk is that we've created low interest rates has allowed debt levels. Private sector debt is what people should be worried about, not government debt. The Australian government could run 200, 300% debt to GDP, and frankly, wouldn't face, I don't think, any real issues. But if the private sector runs excessive debt, well, then that's a completely different story. The private sector can absolutely go bust, and has. And so I think low interest rates for a very long period of time, and then combined with the scarcity of property in Australia. So like you could point the finger at so many people here. State governments, their zoning, the way that they've dealt with land release, the way they've dealt with infrastructure and how hard it is to get outside of Sydney with traffic and all that. Whether you look at local governments and how hard it is to, put another level on your house, they've just pretty much everything you could do to create high prices in Sydney and Melbourne, they've tried to do. And so, I mean, that's concerning. I think unless there's a supply response, it's hard. You really need a financial crisis to drive down prices. And so, I don't own any Australian property, and I've been wrong for 20 years, but I have no desire to buy any anytime soon.
Okay. One here from David. In a low rate world, therefore putting aside the opportunity cost argument, is there a place for gold in portfolios? And likewise, what about infrastructure?
I mean, I think they're that's a good question. I think they're two different investments. So infrastructure is which generally owns, it's generally a natural monopoly, or it's a long-lived asset where there's a lot of large upfront investment, but you tend to have some sort of monopolistic or some regulated level of return. So there's a bit of certainty around the cash flow, and you're able to lever it up more because of that certainty. And sometimes, for example, the government has to step in and say, you can only increase prices this much every year because you're a monopoly, and I'm only going to let you increase prices if you invest capital, and you'll get a return on capital. So infrastructure, I think, is a really interesting investment because you've got inflation-linked cash flows. That can be actually a pretty useful investment to hold in a higher inflation environment. The key question often comes down to, is there too much leverage? And that can change something from being a stable cash flow series to being very volatile. And is it expensive? And I guess the challenge in this environment is, the high quality, regulated, and kind of monopolistic infrastructure assets like ports and things like that. They're pretty expensive. And so, but look, I think infrastructure is actually a perfectly sensible asset to invest in this kind of environment, and it throws cash flows off. Gold doesn't throw cash flows off. Gold is a commodity. Some people say it's a currency. It's definitely, I think it's more of a commodity. It doesn't produce anything, and so therefore, to value it, you have to have a view about what you can sell it to somebody else in the future. It is used in production, and so you could argue that there's a sort of a replacement cost or some kind of marginal cost price. But historically, gold is an asset that has been associated with currencies. It's also very scarce, and so that creates some sort of perceived scarcity value. And so I think I can see why people want to own gold. So the opportunity cost of owning gold, as pointed out, is low when interest rates are low, because I'm going to put the money in the bank. I'm not getting paid anything, so I might as well put it in gold because I'm not paying for it. So I think that's actually a pretty, I don't have any issue with that argument. I think that I can see that opportunity, that reason. So in an environment where there is extreme uncertainty, and you're not paying a lot for cash, I think gold's a perfectly reasonable commodity to have in your portfolio. I just don't think it's something that is easy to value, and so therefore you just have to recognize it's very uncertain. Now, if I was an Austrian economist, I'd completely disagree with everything I've just said and say that I don't know what I'm talking about. But gold is an asset where there is no cash flow, so therefore there's no settling that debate.
Yep. This is particularly relevant, I think, for Australia and those over in Western Australia. Outlook for commodities: more to come or overdone at this stage? And I'm thinking,
really depends.
Iron ore.
Yeah, it's a tough question. So iron ore has been, people have been calling the end of this iron ore cycle for a while. I would say that this, if you think back to 2000, sort of before the global financial crisis, when you saw, there was a shortage of iron ore because, there was really no investment in the sector for a decade and a half. China ramped up. There was undersupply. Prices went through the roof. Then there was a massive, expansion in capital of all the mining companies. Port Hedland was just expanded. I think there was three big expansions that happened there. So it was a huge supply response. And then, what happened is what always happens with these things, is that, they overinvested, there was excess supply, prices fell. But following that period, we really saw sort of a sideways movement in supply. But we saw China continue to consume, mainly steel, produce steel. So now we're at a point where there's supply coming, but it's not as significant as it was previously. And Vale, which is the Brazilian iron ore manufacturer, they effectively had that tragic. There was a tragic dam burst in Brazil, and so they've significantly cut their iron ore supply. And so I think there's an argument to be made that commodities are probably going to stay higher. Iron ore, there could be some supply coming, but I think oil is undersupplied, structurally undersupplied at the moment. And given the hammering that these shale businesses have taken in the US, there's just a reticence to overinvest. A lot of the smaller companies and those funded by private equity are demanding free cash flow returns now. So I think there's an undersupply on the oil side. Gas looks tight. So on balance, I think we're probably in a tightening commodity environment. And I think there's actually some really attractive, commodities actually outside of some of the gold miners. Generally commodity companies look reasonably priced, and we think oil companies look just outright cheap still.
Okay, and question along similar lines: uranium.
Yeah, uranium. Yeah, it's a good question. In a portfolio I run in the US, I actually own Cameco, which is one of the largest. I think it's the second largest beyond the Kazakhstan company that produces uranium. And so uranium's been tricky because it was kind of oversupplied for a period, but the uranium market operates generally, I think 90% of uranium trades on long-term contracts. So a lot of the utilities that consume uranium, so they're obviously nuclear plants, have to buy it on very long-term contracts. And so, but the spot price has been really low because of the oversupply. So we're starting to see the spot market tighten as supply is kind of, being reduced. The big question is longer term, will China continue to add nuclear plants? And it looks like they are adding plants. Germany went really extreme on the other direction after Fukushima. But nuclear actually is if you think about environmental impact of fossil fuels, nuclear is actually one of the best sources of energy, especially base loads to get when you're dealing with renewables. So I think uranium is going to be a core part of the global energy portfolio, and there's a huge amount of work being done now to change the type of reactor that's used to generate nuclear power. And so a lot of the meltdowns relate to the fact that these things can't be shut down. And so they're pretty risky. And so there's a lot of work. So I would bet that that they're going to solve that, and you're going to have safer nuclear. And I think uranium is probably going to be an important commodity, and I think it's undersupplied right now. So yeah, I think it's interesting. It depends on the company, but I can say that I'm overweight uranium in my portfolio.
Okay, thanks, Daniel. Couple of questions, and this seems to pop up fairly regularly on the old cryptocurrencies, Bitcoin, etc.
Yep. And the question?
And the question is, any thoughts?
So I think so gold. If gold is hard to value, then then cryptocurrencies gets its own too hard basket, too hard pile. So I think to me my concern with cryptocurrency is it's got all the hallmarks of a mania. It's one of the more dangerous ones because blockchain is complicated, and people that mine Bitcoin and work to understand it, they put a lot of work in. And so the human mind works in a way that, well, if I put a lot of work in, then surely that means I should get a good return if I speculate on cryptocurrency. And the challenge is, like, just because you understand it doesn't mean you can do any better speculating on it than anybody else. You might as well be speculating on green lumber or coffee beans or whatever. So the question of whether or not the very constrained supply of Bitcoin is going to be enough to create this scarcity value. I mean, obviously, Bank of New York is going to be. They just invested in a business that specializes in the storage of cryptocurrencies, so that they could start to custody cryptocurrencies for institutional investors. Coinbase, obviously, I think it's one stage its IPO was 80 billion. It's come down a lot, but it's being validated as an institutional investment. But to me, it's got all the hallmarks of a speculative mania in an environment where easy money, like I talked about inflation. I don't think low interest rates or the kind of the federal central bank policies drive inflation. I think it drives speculation. I think it drives people to drive asset prices up, and I think that's what's happening in cryptocurrency. So I would be very cautious about it, but I said the same thing at 40,000, 30,000, 20,000, 10,000, 5,000, 2,000. So I guess my view at whatever it's trading at now, I think maybe at 50,000 or whatever, is probably worth as much as it was when I set it at 2,000.
Okay. Somebody's asked about the outlook for factor tilts, like leaning into value, small cap versus growth. What are your thoughts, value versus growth?
Yeah, I mean, we do a lot of work on that in the US where I'm based, because there's just an absolute obsession with it here. People love the style box, they love large cap growth, large cap value, mid cap growth, small cap value. So the style indices are an obsession in the US. So it's a bit like, having to sort of, for foreigners when they come to, if they're unfortunate enough to go to Melbourne, they've got to follow the AFL. If they're fortunate, they live in Sydney, they get to follow the NRL. But you kind of have to follow it. So I follow the style boxes in the US, and I would say that traditional value stocks, as in low PE, low price to book, low price to cash flow, high dividend yield, they appear very underpriced relative to history, and they appear very underpriced relative to growth stocks. I would say small value certainly in 2020 was even more extreme than large. So small value in April of 2020 looked like incredibly underpriced. But that's closed as small stocks have rallied a lot. And so right now, if you look at value versus growth, I still think, if you look out 5 to 10 years, I think value is likely to significantly outperform growth, especially in the US, but in the developed markets as well. And I think that the level of outperformance of growth and the valuation spread is pretty much more extreme than what it was in '99, when obviously you had the tech bubble. The difference is some of these large cap growth stocks are phenomenal companies like Google. I don't know if you saw Q1 earnings results for Google, but I think the earnings are up like nearly 100% for the quarter on quarter. So they're great businesses, but they're priced to be unbelievable businesses. And so I think we're likely to see I don't know that maybe growth will fall in price, but I think we're likely to see it sort of go sideways and deliver pretty mediocre returns, and value is likely to benefit. There's going to be more growth available for investors, effectively as the cyclical expansion increases. Traditional cyclical businesses are going to be growing as well, so you're going to have more choice for growth as an investor, and I think that's going to weigh down on growth stocks and support value stocks.
Okay, we've got time probably for one or two more. What are your thoughts on fixed income fund losses?
So fixed income fund losses, as in
I would imagine in a rising interest rate. Yeah,
bond. Yes, yeah. I mean, I think they're going to be more likely because interest rates are so low, and duration is longer generally when interest rates are low. Just the way bond pricing works, the sensitivity to interest rate prices increases because of the convexity of bond prices that's embedded in bond prices. So I think when rates get low, volatility goes up, and so I just think you're going to have more losses. Whether or not bond yields rise back to the levels they were, in the last decade, I just don't know. Governments can keep bond yields very low for a long period of time. Theoretically, governments don't need to borrow money to spend. They could just spend straight from their central banks. So I just think it's really uncertain. But with rates so low, and with some of the good questions that were asked earlier, I think rates are likely to rise, but I don't know to what level. But governments have an incentive not to let them rise too far because they've got so much debt. So on balance, you'll probably see more volatility in bond portfolios, in bond funds, but you may not see the type of downside if interest rates went back to sort of 6% in Australia, which is probably unlikely given the level of debt and the structure of the economy. But yeah, if you're a bond investor, I mean, it's expect low returns and high volatility. It doesn't sound very appealing.
Yeah. Let's try this as our last one. What would be your top 3 triggers for a major pullback in equity markets over the next 2 years?
That's a good question. So, I mean, I think the most obvious one, I think, where we sit right now is if there's a mutation, or we find that, let's say, I've had my first shot of the Moderna vaccine. I'm about to get my second shot next week. A lot of people have been crook from their second shot. Let's just say people who get their second shot start dying about a month afterwards, and I'm going to get that. That means I'll be gone in July. So, let's say something like that happened, or there's just, because there's a lot of uncertainty with it. I don't think that's likely in any sense, but it's something that really shocks people about the economic recovery and leads governments to just, to do what they did last time. So I think that would just be, I think we could see even a deeper contraction in equity markets than we saw in March 2020. I think it's very unlikely, but that to me, there's a lot of things that could happen with mutations. I think that's very, very, very unlikely. But to me, that would be a shock around that. The second item would be effectively an inflation scare, where, because you've got a lot of tight supply. For example, people saw the Suez Canal and the tightness in shipping and everything. Like, effectively, if you just had a really big shortage that hit a part of the market, we could see an inflation pulse, which is different to high inflation, but a pulse that shocks people. That could really back up yields, and that could really back up equity discount rates, could send prices down pretty quickly. So that would be kind of, let's say, that's a tightening risk that I think is actually probably not a super low probability, but I don't think likely. So people should be bracing for that kind of shock. And then thirdly, look, I think you've got there's a lot of geopolitical uncertainty around the world at the moment. Arguably, COVID-19, rather than creating more unity, it's actually created more division. Even within Europe, countries have been fighting over vaccines. And so, I think, some kind of geopolitical issue in China, I think with the Biden administration wanting to stamp their authority in the South China Sea, some kind of geopolitical shock could be something that could do it. But look, it's always hard to predict these things. And frankly, on balance, we'd be buyers if it happened. So because we've got cash and they generally create opportunities for us. I didn't provide this, but the big question, I guess, as a sort of a long-term investor right now is, as this cycle plays out, how long is it going to be? Is this actually a new cycle that started at the beginning of 2020 or March 2020? Or is it actually the same cycle that started in 2009, and that was an exogenous shock, and then the government's got the train back on the tracks, but now there's huge fiscal policy, and the economy could be tightening, and we could start to see inflationary pressures. So central banks may very quickly have to put the foot on the brakes, and governments have to pull fiscal policy out because they're worried about inflation. Because inflation can occur if demand exceeds supply, and if governments overstimulate, you could start to see demand-driven inflation. That could be, we could be in a 3-year economic cycle or 4-year economic cycle. That's the question that I've been thinking a lot about. Obviously, I don't have an answer, but I think that's kind of what's keeping me up at night at the moment, is thinking through that.
Okay. Well, thank you very much, Daniel. Always incredibly insightful, and we're now 5 minutes over time. So I'm going to have to wrap this up. As we said, there will be CPD points issued in the next week or so, and there will be a recording of this, so you'll be able to refer to that as well. Thanks everybody for your time today, and enjoy the rest of your day. Thank you.
Thanks for the questions. Thanks, Pete. Thanks, everybody.